Two men. One made his fortune with a strategy so patient, some have called it lame. The other is literally trying to build cities on Mars. Warren Buffett and Elon Musk are two of the wealthiest people on the planet, yet their playbooks for getting there are polar opposites. Buffett, the Oracle of Omaha, built his empire by buying solid, easy-to-understand businesses and holding them for decades. Musk, the Technoking, bets huge on radical, world-changing ideas. So, if you're just starting out, who do you follow? The slow and steady tortoise, or the high-risk, high-reward hare? The answer isn't so simple because the right strategy depends completely on you. In this video, we're going to break down these legendary approaches into simple, practical first steps anyone can take. We'll get into the core philosophies, the risks, and the potential rewards to help you decide if you're a patient value investor or a high-growth innovator. Warren Buffett is probably the most famous investor alive, and his strategy is beautiful in its simplicity. Buy wonderful companies at a fair price. This is the core of value investing, an idea he picked up from his mentor, Benjamin Graham. The thinking goes like this. The market is emotional and often freaks out over good or bad news. This causes a stock's price to disconnect from the company's actual long-term worth, its intrinsic value. A value investor's job is to spot these overreactions and snap up quality companies for less than they're truly worth. Buffett isn't looking for a quick win. He once famously said he buys stocks assuming the market could shut down for the next 5 years. That long-term view is everything. He's not trying to time the market or chase what's hot. Instead, he hunts for companies with a durable competitive advantage, something he calls an economic moat. Think of a castle with a huge moat protecting it from invaders. For a company, that moat could be a powerhouse brand like Coca-Cola, a market-dominating position like Apple's, or an unbeatable low-cost structure. These moats keep competitors at bay and protect profits for the long haul. So how can a beginner actually use Buffett's wisdom? First, stay inside your circle of competence. This is one of Buffett's golden rules. Don't throw money at a biotech firm if you can't explain what they do. Stick to industries and businesses you genuinely get. This cuts down your risk because you're way better equipped to judge a company's future. Second, learn to do some basic homework. Value investing isn't about gut feelings. It's about digging in. Start by looking at a company's financials, its income statement, balance sheet, and cash flow. You don't need to be a Wall Street wizard, but you should grasp the basics. Look for a track record of consistent profits and manageable debt. Key metrics that value investors love, like a low price-to-earnings ratio or price-to-book ratio, can signal that a stock might be on sale. Third, practice patience and keep your emotions in check. The market will swing. Your portfolio will have red days. Buffett's genius comes from his ability to stay cool when everyone else is panicking. A huge part of value investing is having the guts to hold on for years, even decades, giving that hidden value time to shine. This buy and hold approach is a classic for a reason. It lets the magic of compounding do its work. Fourth, demand a margin of safety. This is another gem from Benjamin Graham. It just means buying a stock for a lot less than you think it's worth. This buffer protects you if your math is a little off or if the company hits a rough patch. It's like looking both ways before you cross the street, even when the light is green. Elon Musk's strategy is a whole universe away from Buffett's. He's not digging through spreadsheets to find undervalued companies in boring industries. He builds and invests in companies founded on ideas that could completely reshape our world. Think Tesla and the electric vehicle revolution, or SpaceX and the mission to make us a multiplanetary species. This is growth investing with the volume turned up to 11. It's about backing a world-changing vision, not just a solid balance sheet. Musk's entire philosophy is built on high-risk, high-reward ventures. He famously said, "Failure is an option here," a mindset that lets him chase goals so ambitious they scare everyone else off. While Buffett avoids what he doesn't understand, Musk dives straight into the deep end of cutting-edge fields like AI, neurotechnology, and rocket science. He isn't just a passive investor, he's the builder, pouring his own money into the companies he creates. Now, trying to be the next Elon Musk is probably not in the cards for most of us, but you can absolutely apply his growth-focused, innovation-first mindset to your own investments. Here's how. First, spot the high-growth trends. Instead of looking for stable, mature companies, a growth investor is looking for sectors with explosive potential. We're talking about fields like artificial intelligence, biotech, clean energy, and robotics. The goal is to find companies that are set to grow way faster than the overall economy. Second, brace yourself for volatility. Growth stocks, especially in tech, are famous for their wild price swings. News, hype, or a setback on a long-term goal can send the price soaring or crashing. If you're going to follow a Musk-like strategy, you need a high tolerance for risk in the stomach to watch your portfolio go on a roller coaster ride without hitting the eject button. As Musk himself says, don't panic when the market does. Third, focus on the vision, not the current profits. Many of the biggest success stories, like Amazon or Tesla in their early days, didn't make a profit for years. They plowed every single dollar back into the business to get bigger and better. When you're looking at a growth company, you're not just analyzing its past performance. You're betting on its story, its leaders, and its potential to own the future. Fourth, think long-term, but be ready to pivot. Just like Buffett, Musk is in it for the long haul. But the tech world moves at lightning speed. A growth investor has to stay plugged into industry news and be willing to adjust their strategy when a new technology emerges or a company's direction changes. All right, let's put these two strategies in the ring together. Risk level. Value investing is generally the safer bet. You're buying established companies that you believe are on sale. Growth investing is much riskier. You're betting on a future that might not happen, and let's be real, a lot of young, innovative companies flame out. Time horizon. Both are long-term games, but the ride is totally different. A value investor is hoping for slow, steady growth over many years, like climbing a long, gentle hill. A growth investor is strapping in for a rocket launch, one that might have a few terrifying dips and stalls along the way. Source of returns. With value stocks, your money comes from two places: the stock price eventually rising to its true value, and dividends paid out by the stable company. With growth stocks, it's all about capital appreciation, the stock price going to the moon. Most growth companies don't pay dividends because they're reinvesting everything they have. Market conditions. Value stocks have historically been a solid place to be during economic downturns because they're seen as safe. Growth stocks tend to shine in bull markets when everyone is feeling optimistic. For years, tech-heavy growth stocks have been the clear winner, but some experts think that changing economic winds, like higher interest rates, might bring value investing back into the spotlight. Before we figure out which path is right for you, a quick but important disclaimer. This video is for educational purposes only and is not financial advice. All investing involves risk, and you could lose money. It's always smart to look at your own financial situation and maybe even chat with a licensed financial advisor before making any big moves. Now, if this breakdown is helping you find some clarity, do us a favor and subscribe to the channel. We drop new videos every week that make complex financial topics simple and actionable. Choosing between Buffett and Musk isn't about picking the better billionaire. It's about figuring out what kind of investor you are. To do that, you need to answer 3 honest questions. First, what's your real risk tolerance? Seriously, be honest. How would you feel if your portfolio plunged 30% in 1 month? If that thought makes you want to bury your cash in the backyard, a high-growth Musk strategy is probably going to give you an ulcer. You'd be much happier in the calmer waters of value investing. But if you see a big drop as a potential sale and have the nerve to ride out the storm for a shot at a massive payoff, then you might just have the mindset for growth. Second, what's your time horizon? How long can you let this money sit without needing to touch it? If you're saving for a down payment on a house you want to buy in 3 years, you can't afford the wild swings of growth stocks. A shorter timeline demands a safer approach. But if you're in your 20s and investing for a retirement that's 30 or 40 years away, you have plenty of time to bounce back from market dips, which makes a growth strategy much more realistic. Third, what are your goals? Are you aiming for a steady stream of income when you retire? The dividends that mature value companies often provide could be a perfect match. Or is your goal to get the biggest possible return over the long run, even if it means a bumpy ride? In that case, the explosive potential of growth stocks might be calling your name. And remember, this isn't an all-or-nothing choice. A lot of smart investors build a portfolio with both. You could have a solid core of stable value stocks, your Buffett side, and then use a smaller part of your portfolio to take shots on high-risk growth stocks, your Musk side. This barbell strategy gives you stability while still giving you a ticket to the innovation lottery. Warren Buffett and Elon Musk carved out two wildly different paths to staggering wealth. Buffett's path is paved with patience, discipline, and a deep knowledge of business. He waits for the perfect pitch and swings for the fences. Musk's path is a rocket launch powered by a bold vision, an iron stomach for risk, and an unstoppable drive to build the future. For a beginner, the lesson isn't to just copy one of them. It's to use their philosophies as your guide. The Buffett approach teaches you the timeless wisdom of doing your homework, staying disciplined, and never overpaying. The Musk approach reminds you that the biggest wins often come from betting on the future and embracing change. Your investing strategy should be a mirror of your own goals, your timeline, and your comfort with risk. Whether you choose to be the tortoise, the hare, or a little of both, the most important thing you can do is get in the race. The biggest risk of all isn't choosing the wrong billionaire to follow. It's staying on the sidelines and not letting your money work for you at all.